let's talk a little bit about why we want to use options instead of just trading spot FX. There are really a lot of reasons for why you want to do this, but today we're going to show you two very specific strategies for why options make so much more sense than going outright spot in many ways. The first and foremost is that options allow you to take a directional risk without the fear of a stop out. And I don't know how many times all of us in the spot business pick a direction, take a trade, get stopped out, only to watch the trade completely reverse into our direction, then go on to hit all of our profit targets. And this is actually much truer for somebody who trades on a longer term time frame, like on a swing time frame, than anything I ever know. The FX market is notorious for doing this, which is taking you out of your stops and then going on to hit your limits. One of the greatest things about options is that this is the one thing you can avoid. You can hold the position irrespective of what the price of the underlying is, as long as you have duration on the option, as long as the option doesn't mature. And sometimes what happens is you could have a move against you and then a move for you completely in your way and come back and make money on the position, something that you would have lost money on spot. The second strategy, and this is a really interesting strategy for a lot of you guys, is the ability to enter market at limit and get paid for it. A lot of FX option traders like to buy spot at a particular price. Let's say the market right now, let's say the Aussie is 106.50, and you say I don't want to buy it until it comes down to 106 or 105.50. That's my support level. Well, using options, you can actually create a strategy, and we'll show you how you can create the strategy that will allow you to enter into a position only if Aussie comes down to 105. But in the meantime, you could collect money even if it never comes in. Let's say it runs away, goes to 107, 108. You can still collect premium and make money even if the trade never comes into your direction. This is one of the coolest ways of actually taking advantage of options, and we'll talk to you a little bit more about that as it progresses. So let's move on to the next slide, Justin.
So why don't we we'll take a look at what Boris is talking about. All right, can you guys see the trading platform now? Okay. So a couple of weeks ago, we're taking a look at a Euro chart here, and to go into what Boris was talking about, we had this nice trend line here. And if we were thinking about entering a short position in spot right here at the top of this trend line, put a sell in at about 32.80, and think about putting a stop about 100 pips higher. And as we watch time unfold here we go. Okay, so here's our entry, and immediately blows through, and you're stopped out 100 pips higher. And as time goes by, here it comes right back down again. And yesterday we had an opportunity to actually trade about 180 pips below what our original entry would have been, but we were out of the trade already because we just had that quick flurry up, and it took us out of our spot trade. Now instead, if we decided to use an option, what we could have done is taking a look at our option quote board here, and on the right here we have the 131 put that expires in about 41 days, and this is our order form here. If we were to put this put on 23rd on the same day as we entered our short spot position, it would have cost us about 100 pips. And when this market rallied up from 32.80 up to 34.50 or so, we would have been taking a floating loss on our option, but we would still be in this position, knowing that the most we could lose is that 100 pips. Then as the market sold off, came back down to our entry level and even 150 pips below, we would be in a position to either be at least scratch and probably up on this trade. And we actually ended up hitting our target at about 131 even yesterday. So this little random bit of volatility that we saw to the upside that quickly reversed, took us out of our spot trade, but had we done the option instead, we'd have the durability to stay in and actually exit that trade for a gain potentially. So I'm going to hand this back, Boris, and we'll move back.
One of the cool things that Justin had showed you, I think, is the asymmetrical aspect of the options trading. The first two things that you see in this particular example in the euro is that you're not taken out of the trade when it goes against you. You get to sit around and hold a position, unlike spot where you're just basically in position, right? However, this is you have to wait until expiration to take advantage of them. So, for example, yesterday, right, when the option really dipped down low and you were, let's say, plus 100 in profit, you could have taken the profit live, in the marketplace. This is the great thing about the GFT options platform is that you're not obligated to hold these things all the way to maturity. So you get the best of both worlds. You have like 30 or 40 days to see if your position works out, and then in a day or two, when things move your way and you think and you can take advantage of the market, you get to take advantage of the market and get to lock in your profits. So that's the really cool thing about the asymmetrical aspect of options that I kind of just want to emphasize.